Good morning, everybody. My name is Rose Kervick. I'm a director with Accountant Online, and this is today's session is called Financial Storytelling: Building a Robust Financial Model. And with me is John Brennan from Westbic. And John has a great background in supporting entrepreneurship, and based in Galway. Isn't that right, John?
That's right,
you're in
Rose.
Galway, yeah. So the Westbic is a few weeks ago, we had Dublin BIC representatives on to help us with some of the startup and funding questions that our audience had. And today, John is going to help us with this piece, which is around financial storytelling. So, John, as you were saying, many entrepreneurs can tell a great, perhaps, story about their technology or their the audience, the goals they want to achieve, but it can be harder to put a financial model around that and show how the business may grow and scale in the coming years. And that can be hard when we're trying to raise money for or try to get funding either from the bank or from grants or from private equity funders. So your job really for quite some time has been around helping entrepreneurs tell that story. And we're delighted to have you here today, and you're very welcome. We've got lots of, we've over 100 people who registered for the event. So I'd like to encourage you all attendees today to just drop me a message in the chat or in the Q&A. And John, as you're talking to us and presenting your slides, we may stop you every now and again with some questions from the audience, if that's okay.
That's perfect, Rose. Thank you.
So if you'd like to begin, we're looking forward to hearing your experience and how you may help us. And let's get going.
Great. Thanks very much, Rose. And thanks to the guys at Accountant Online for inviting me to share our perspective on financial modeling and financial storytelling with you today. And welcome, everybody. I'll just start with maybe a little bit of background. So Westbic, we're a bit like Rose was saying there a few minutes ago, we're one of 4 BICs in Ireland, the others being Cork BIC, Dublin BIC, and Southeast BIC. So we're all EU accredited business and innovation centres, and our region is the northwest region. So we work, if you like, from Galway up to the top of Donegal and out almost to Athlone, and that's broadly speaking our region. We're a specialist provider in the government's portfolio of supports to industry, and we work very closely with Enterprise Ireland and particularly the HPSU unit. And essentially our job is to work with startups and scale-ups and get them to an investor-ready stage. And we work through a fairly detailed process in trying to reach that objective. The support process that we engage in is very much on a one-to-one basis. So we're typically not working with groups, although that does happen from time to time, but it's usually on a one-to-one basis. We're working with the founders and the key members of the team, and we're trying to progress that business to the investor-ready stage. Most founders come from a technical background, sometimes a marketing background, but we very rarely find somebody coming in the door with a financial background. And that tends to be a challenge because as much market research as you do, as much as you know about the technical side of your product, you do need to convert that information into a financial context at some stage. And therefore, you need to start working with a financial model, and you need to become acquainted with that, to build your financial strategy and to be able to express that strategy in a coherent way to investors or funders, whoever they might be. At each stage of a business development, there's decisions to be made, and a lot of these, are strategic decisions, and they differ from one stage to the next in terms of where your business is at. So an early stage business, their objectives, short to medium term objectives might be, trying to secure funding at the startup phase, and to reach a number of milestones, which will then maybe open the door for them to secure additional funding. Scale up business might be looking to capitalize on the market potential and secure funding for that objective. And then other businesses who are maybe a bit more developed might be looking to expand internationally, and how best can they do that? Whatever the objectives are, there's usually requirements that come with that. Some examples that are typical that we experience on an ongoing basis is, usually you have to build a team, and that's a key objective for many startups. Is you start maybe with one or two founders, but to achieve the objectives of the business and to scale that business, you're going to need to bring on a lot more team members, and you're going to need to add to your skill sets. You might need to set up a team in a geographical market. So setting up a team in the UK or the US, for example, is expensive, and that might be one of the requirements of your expansion plan. There might be CapEx issues, or there could be a requirement. Your funding might be not just about money. You might also need people that have access to contacts, access to markets, access to networks, and therefore we often are looking for the smart money to come in with investments, not just money, but money and know-how. Joining forces is really powerful.
And John, when people come to Westbic, at what stage would they normally be? And would they be lifestyle intention businesses, or are they all around kind of scaling and
yeah, it actually varies, but most of the companies we work with, we start with them at an early stage. But what often happens is they may secure fundings through, for example, business angels and the likes of Enterprise Ireland for the first seed round. But that usually will get them a certain distance down the road, and they may come back to us then looking to assist them again in terms of the scaling side of the mix, in terms of securing additional funding for scaling purposes, such as going international, trying to build out the team, trying to capitalize on the market potential that they have tapped into at an early stage. So it can vary actually. And we also, it's not always just the HPSU guys we're working with. We are also working from time to time with maybe slower growth businesses that are looking at options in terms of how they can expand their business, whether it be nationally or internationally.
And HPSU is high potential startup.
Startups, yeah. So that's an Enterprise Ireland term, which has become sort of commonplace in Ireland, at least, to reference those high growth startups and they're typically the ones that are going to grow very quickly over a 5-year period. They might start off somewhat gradual in terms of the way they scale, but the expectation is over a 3 to 5 year period, they will scale at pace. And they're also the businesses that are most likely to attract private sector investment, because investors can see that they will generate a return from those businesses. So just going back to the slides for a minute, depending on what your objectives are, that brings, a number of issues that you need to address, whether it be building the team or CapEx or whatever. But there are also implications for the business. And one of those is that you generally need a secure medium to long-term source of finance. That's really important. Once you begin to grow, the 3 or 4 person team that's been around the table and everybody's been involved in every decision. As the company grows, it needs to restructure and reorganize the way it runs the business, so that you might need to put in a management team. You might need to bring in HR. You're probably going to incur additional legal costs. You're probably going to incur accounting and maybe extra office costs. So as you scale, there's a whole lot of issues that you need to address, because you're now becoming, if you like, a more established business with more established structures. And you need to accommodate that as you grow, to make sure there's no bottlenecks in the system, that you can still scale. But many companies, what they try and do is retain that, as Jeff Bezos calls it, the day one sort of attitude, right? That every day is day one, that we have that freshness, that we have that enthusiasm and determination that you have, while at the same time putting in proper structures to grow the business. Yeah. And of course, there's always then, all of that always brings a working capital requirement. And that's why, in essence, you really do need to look at having sort of mapping this out in a financial context, because you need to look at your funding options. You need to understand how long is that line of funding going to service your needs, And do you have a need to go back into the funding marketplace again to secure additional funding? And that's generally what we would find. So, initially the businesses start, they get some seed funding, maybe a mix from Enterprise Ireland, maybe a mix from Business Angels. But to scale, you probably need to go back again to the investor marketplace and secure additional funds, maybe going up to like a Series A round of funds over 18 to 24 months. And that needs to be built into your model. And that's what investors typically are looking for, that you're not just considering the next 24 months, but they want to see that you're going beyond that. Sometimes that can be difficult, but I think it is important to try and look down the road and see, what will the needs of the business be over a 3 and maybe in some cases up to a 5-year period. And then the final point I would make there is that you need to test all of this. You need to look, there are different strategies that you can take to develop the business. And all of those have an impact on the business. They have an impact on how fast you scale. They have an impact on the equity that you give away. So there are a whole lot of considerations that you need to take account of in developing the model. In terms of the model itself, I think you need a flexible model, because as you just alluded to there, you need to be able to flex and adjust and change the model as you get information from either the market, your potential customers, or indeed if you might get information or feedback from investors in terms of what the likely round of funding, that might be available to you. I think it's important that the owners, the founders, as we call them, take ownership of the process. They don't necessarily have to be the people that are plugging the figures into the spreadsheet model, but I think they need to take ownership in the context that they need to understand how the technical and the market information converts into a financial scenario and what the financial implications are of each decision that they make. Because there's lots of variables that you can play around with. And though whatever decision you make and whatever adjustments you make in terms of decisions you make with regard to variables in terms of recruitment, in terms of your marketing, your business development, they all have a financial impact. So you need to sort of understand and consider what's the right mix for your business at this particular stage. Investment is really
that's hard when you're not a financial person. I think at the beginning, I think we would tend to shy away from even wanting to look at that.
And I agree totally. And that's one of what we try and do with our models is we're not trying to make anybody an accountant, but we're trying to make it simple, so that simple but robust, so that a founder can understand the impact of various sort of
key numbers, I suppose.
Yes, absolutely. And in terms of the decisions that you make. So do we employ 5 in year 1 and 10 in year 2 and another 15 in year 3, or do we take a slower route? And even drilling right down, as we'll see now in a minute, going right down into the months in terms of when you employ people can make a difference. The amount of money that you spend on your business development costs, in terms of customer acquisition costs, that kind of thing. Also, what element of R&D do you need to continue with? Because typically, when we're working with startups and even scale-up companies, the product still isn't developed to the level that they would ideally like. So there's an ongoing product development and R&D requirements there, and that can also be considered in the context of the funding mix, because there might be additional funding that can be sourced, through grants, etc., to support that process. But all of this needs to be considered, I think, in a really robust, flexible model that, as I said, the founders can take ownership of. They can see how much investment is required, and they can also flex the model, because it's in looking at the various options that you have on the table that you arrive at the best, I think, financial strategy. So I'm just going to run through, I just have a couple of screenshots here of one of our financial models in terms of how we approach it. And as I say, we were obviously using an Excel spreadsheet with many sheets at the bottom of the model. But what we're trying to do is confine maybe 3 or 4 sheets that the founder has to input the information, and the rest of it is formula driven from there. So typically what we do is we start with the pricing. Well, we start actually with the start date. So the projection start date is important.
Okay.
One of the reasons that's important actually is that you often have to integrate your prior year financial figures into the model so that you're starting off, and this, we're getting a little accounting like here, but you want to start off with the right opening closing balances in your balance sheet. And the
And when
balance
is
sheet,
that? Is that when you start spending money even?
well, often, so typically if we're starting this model, say as it's set up there in this slide,
Yeah.
July 20, we want the balance sheet figures at the end of June 20 would
Okay.
be the ideal position. And that's maybe something we can touch on later, but
Yeah.
I think it's important for startups also to work with the likes of yourselves in terms of, you know, dealing with their accounts on an ongoing basis. Like
Yeah.
the accounts are an important function of the business.
Yeah.
And often, you know, at an early stage, there mightn't be a lot happening in terms of revenues, but there's certainly maybe costs going out.
Yeah.
And maybe there are VAT issues to be dealt with. And we would recommend that, you know, they get an accounting package or they get somebody such as yourselves to support them with the accounting process at a very early stage, because it can
Yeah.
save a lot of hassle down the road.
Yeah.
And it also allows them, you know, if they're going for funding, typically they will have been on the road for a while. There will be prior accounts there in existence.
Yeah.
And they do need to be ideally integrated into a model like this. So that's one of the reasons we would say, you know, the start date is important, because ideally we want to integrate your prior year accounts or your prior month accounts into this model, because the balance sheet will tell a lot, and investors will look to the balance sheet to see how clean is the balance sheet. And maybe we can talk about that in a short while. But in terms of the model, we start off with the pricing, and we try and allow for the flexing of the pricing. So in this is just a sample model. It's not an exact example of anybody's business.
Okay.
But we just, you know, product one, product two, and also these guys have a SaaS products, software as a service type of product, which is subscription based. So it's obviously a technology company, two products, also maybe a cloud service combined with that. And what we want to allow them to do is, okay, product one sells at 1,500, product two is 500, and then the annual subscription is 1,000, which is obviously linked to those products. But we want to allow the startups to easily flex that. So if they want to see what's the impact of maybe that pricing going up, you know, by maybe 10%, 20% year on year, or maybe it can be difficult to do that, but maybe after year 3 they can have a price increase. We try and build that into the model, so that's easy to do. The next step then is to look at the unit sales. So again, typically in a startup stage, you're talking about shifting small units, and it's as well, you know, it's as well to be realistic in terms of how this is going to grow. So the figures here should reflect the market information you're getting from your market. It's probably closely linked with discussions that are going on with customers, etc. And that's the next stage. And again, you want to be able to allow for that to grow over a 3 to 5 year period. If there are direct costs, which there are in this case, we need to plug those into the model as well. And again, we try and make that as easy as possible for the founders. One of the items I touched on earlier was the staff costs and salaries, and you can see here the team here is made up of the CEO, CTO, etc., engineers, salespeople, and we're trying to plot out on a month-by-month basis over a 5 year period when these guys are going to be recruited into the team. And you can see it can be kind of haphazard in a sense. It's unstructured in one sense, but what we're trying to do is map out the reality. So we can get a true cost of the HR costs, because in many cases, and particularly with the likes of a tech company here, your know-how is really your engineering team and your software team, etc. And it's important to know when you're going to recruit these guys and recruit them at the right time, because they also tend to be expensive in terms of the cost to your business. You also need to build in overheads, you know, and I'll just give a snapshot here. There are many other categories of overheads. We just looked at 3 here, which is R&D, marketing, promotion, and hosting. You know, you'll have your utilities and everything else in addition to that. And again, we're trying to plug estimates of these costs in. R&D is often a significant cost in the early stages, and often it needs to continue because you need to, develop the product further as you get greater exposure in the marketplace and build up your customer base. That once you plug that information in, and that's essentially as much as we're looking for people to input into the model. The model then generates a profit and loss account, cash flow statements, and balance sheet. The model will generate both annualized versions, monthly versions, quarterly versions, and also we can track the cash flow movements, which is slightly more accounting thing, but it's useful to do as well. I just maybe focus in on a typical model and a typical kind of scenario that would arise, which we would sort of see on a regular basis. This might be a startup business that's has got traction in the marketplace, is bringing on customers, and they feel that they can generate 300K of sales in the first year, and the expectation is that they can get that up to close to 8 million over a 5-year period. Because they're starting the business and they're scaling the business, and there's a lot of startup costs, and they're building the team, which would probably a big chunk of the cost. And cost, it looks like they're going to make an operating loss of nearly 600K. It then goes up to 768, and then as things begin to level off, and as sales begin to really take off in year 3, that operating loss is coming down to 267. So the only way you can fund that type of activity, and this is typical of what happens with a startup, is you need investment to support the growth of the business in the early stages when the costs are higher than the sales. And as you're building your team and as you're building out the capability of the organization, the costs come first, and unfortunately the revenues follow. And therefore, there is a deficit that needs to be financed. And the initial figures plugged in here was a 600K investment. I'm sure a mix of private and public funding. However, as you can see from the yellow bubbles on the bottom, there's a cash flow issue here, which is, cash flow, it's gone into a negative of minus 22 in 2021, but then it goes up to 1.1, nearly 1.2 million over a 3-year period, and then it begins to come down again. But for a startup business, that just can't happen. You don't have enough goodwill with the banks to allow that to happen. Yeah. That just can't happen. So this is where the model is really important in terms of, what can you do and what are the options here? So let's look at some of the options that these guys might have. So option one is ideally increase investment. Option 2 might be to increase sales, but that mightn't be feasible. That mightn't be achievable. And option 3 is to reduce costs, which might mean, slowing the recruitment plan, slowing your investment in R&D, or maybe reducing the business development costs. So let's look at one option here, which is, let's say we increase the investment to 2.1 million. That certainly addresses our cash flow problems. We're cash flow positive now in years 1, 2, 3, and 4. And once we get beyond year 3, we're scaling the business at a level where we've exceeded break even, so we're generating profits. So there shouldn't be a cash flow problem. However, is 2.1 million feasible for this business? And this is where you really need to consider your options, because if the business is expected to grow to just under 8 million in 5 years, is a 2.1 million investment, going to be feasible? Are investors going to jump for a 2.1 million investment for a business that's going to generate maybe 8 million? Maybe not. Maybe one of the things that's going to support it is that the operating profit, the EBITDA, is quite good. But these are the kind of issues that need to be addressed. And, you can drill down into the detail here. And one of the things you might say is, we not looking to secure 2.1 million here, but maybe we try and secure, it was originally 600K, maybe we try and secure 1 million here, and then we try and secure maybe another 1 million out here in years 2 and 3. So that's, to me, is an example of sort of the practical financial decisions that startups that scale up companies need to make is that when you plug the numbers into the plan and when you plug your ideal path forward in terms of your strategy into a financial plan, sometimes it just doesn't work. And therefore you need to look at, how else can we scale this business and develop this business? What other options are available to us? And how can we maybe hit a number of milestones along the way that will build confidence and allow us maybe to secure more investment? And another point I'd make there is that maybe, one of the downsides in trying to secure 2.1 million here is that you possibly have to give away a big chunk of the company to investors. And maybe a smarter route might be to take in a smaller amount here, hit a number of milestones, excuse me, hit your sales targets as much as you can, build confidence, and then when you get out here into either year 2 or year 3, secure a bigger chunk of money for a lot less equity that you have to give away. So
sales is always better than taking in debt or equity. Then if you can,
absolutely. If you can build, and it depends on the type of business that the nature of the business. For example,
whether it's possible.
Yeah, because for example, a tech type business can often when we're working with them, they're often very close to the market. The guys in the back room can do a lot with, working off, Amazon Web Services and 2 laptops. They can get their product very close to being, close to the market. And therefore they can start generating sales maybe very quickly. A medtech business might be totally different, where they have to go through, a series of clinical trials over a 3 to 5 year period. Yeah. And in that context, it's money going out the door all the time. But every time they hit a milestone in terms of, those clinical trials, they add significant value to the business. And that's sometimes a reason to take in as much money as you need, so that you're not giving huge chunks of equity away at a very early stage. But really, what this is coming back to, Rose, is really the financial strategy employed by the business. These are the issues that need to be addressed, and to allow you to address these issues in a comprehensive way, you need to be able to plug the figures into a model. You need to be able to flex that model. You need to be able to iterate through the model as you get feedback from investors, as you get feedback from the market, etc. So,
and John, we've lots of questions.
Okay.
Well, not lots of questions, but questions around the model. Will you be able to give us an Excel template that we could send out to participants? What you're saying is really keep the model is simple. If we can keep it as simple as possible, and then you're saying for founders, for the owners to really understand those key numbers and not leave it up to the accountant, because it's the owner really knows what is driving sales. The owner knows what is realistic and knows what the feedback is from customers and from sales teams.
Yeah, absolutely. I think you need to take ownership of it. And, as we said already, often the owners come from a different discipline. They're often technical. So their focus is on building the best product ever and getting that to the customers. But, you also need other disciplines in addition to the finance. You need salespeople, etc. But from a financial perspective, you need to understand the implications of, various decisions that you make. And like for startup and scale up businesses, you could say that the big decisions are on HR. Is one thing, your recruitment plan. The next one would be your business development costs and your business development objectives. How much are you going to spend in terms of bringing those customers on board, and what's required in terms of doing that? And that might be a combination of both your marketing plan plus your HR plan, because you might need, for example, a very good quality salesperson and a marketing manager to drive that activity, while the engineering team are driving the development of the product. So there's a whole lot of decisions that you need to make and consider, and you need to understand what are both the upside and downside aspects of making those decisions. And what you're always trying to do, as you well know, is manage the risk, and the big thing for startups and scale up businesses and early stage businesses in general, and I suppose all businesses, is cash flow.
Yeah.
And that's when we look at a model. We would work on a model with a startup, and one of the first places we'll go is when we have an early draft is what's happening in the bottom line at the cash flow on a monthly basis. How much cash have we on the bottom line? So that's essentially your bank account. It's like looking at your bank statement.
Yeah.
And if we're spending, for example, 50K a month on our between salaries and everything else, how many months have we left on the bottom of our cash flow statement each month? Have we got 3 months money? Have we got 5 months money? Have we got 6 months money? That's, it's a small little assessment that you can make on a monthly basis. And I think it's really important because you will make mistakes. There will be issues that you haven't foreseen.
Yeah.
And often you need to be able to make decisions quickly. And often you need the cash flow to make those decisions. And you can change and fine tune, etc. But you need to have a certain amount of cash in the business to manage that process and keep the company viable in the short term.
Yeah.
Sorry, I was just going to say,
yeah.
Go ahead.
No, well, just that you're talking about cash, many of the comments are around cash, and I take it that COVID has really impacted people's cash flow, and
Yes.
a question is about that. What would you recommend to increase the cash flow during COVID? And I imagine that means, yes, they say many companies go bankrupt due to cash flow problems. My question is, what would you recommend to increase the cash flow during COVID? So your model should be so flexible that it's kind of a one pager that we can pull in and out various scenarios out of it and know immediately what the impact is. Is that what the intention with the model is?
Yeah. Yes, absolutely. I mean, we haven't built it with COVID in mind. So what I mean with that is, I mean, COVID has brought a whole lot of, employment subsidies, etc., that companies can avail of and should avail of because, it's those supports, and whether it's rates, rebates, or whatever the case may be, that accessing those supports will certainly help your cash flow during COVID. So we haven't built the model with COVID in mind, and there are probably additional items that need to be factored in a COVID context. But I think the cash flow is really crucial, and that's why we would again say you need to be careful with your key cost centers as you're scaling this business. And that means, often that means coming back to things like your recruitment plan, making sure you're not bringing staff on board until you need them or close to when you need them. Or if you do need to have them in advance of, when, if you like, they're contributing to the bottom line, you need to be able to fund that. So therefore, you need to have sufficient funding in the business. It's a problem with startup businesses that they tend to be undercapitalized. They don't secure sufficient funding. So you have to be really smart about how you manage your money. You have to spend it wisely until you begin to generate sales. Once you begin to generate sales, then you have a better understanding of how the business is working in terms of the balance between the costs and the revenues. But up until then, I think you have to manage on a shoestring as best you can and scale the business wisely and make sure when you're bringing on costs and bringing costs into the business that it makes sense and that you can manage it within the cash flow that you have available to the business at any given stage.
Sure.
So I think we've probably discussed all of these items already in terms of, the revenues, the breakdown of the costs, the investment, how much, when, and an important point there is how much is accessible. And, you know, you need to be realistic about that. You know, there's no point in putting 2.1 million into your spreadsheet if you haven't a chance of getting 2.1 million. And that's where the feedback with investors can be very useful. And you need to look at some of the downside scenarios. Let's say, you know, what if you only generate 20%, or, you know, there's a 20% reduction in the projected level of sales? What impact has that on cash flow? So those items, I think, are very important and help you to develop, you know, what we would call the optimum business strategy, which, and it's, you know, this will change as the business evolves. It will change as you develop, as you maybe bring on customers, as you gain market traction. You know, it evolves, and the strategy might need to change, or you may need to tweak it. But I think that's why it's important to have a model, and to have a model that you can flex. I think another important part of this, which is often sort of forgotten, is the need to be able to tell the story about what's happening in the business, and to be able to, if you like, connect the technical, the market information, and the financial information into one story that basically explains in a very easy way how this business is developed. So we've, you know, on this slide, for example, we're talking in the first instance, we're building capability, which is about building the team and, you know, securing maybe the first customer or two. We then move into developing the market, and adding to the team, adding some key recruits to the team, implementing the sales and marketing plan, and assuming that goes successfully, then we can move to a stabilize and grow. And then from there, we're going to scale at pace. And it's a kind of a simple way of trying to get the message across to potential funders and investors about what the key stages of, what's involved in the key stages of the business over the next couple of years. And you can get into a lot of detail, you know, on a Gantt type chart like this, which says, you know, tries to map out what you're doing at different stages, and, you know, from the funding to the, you know, the HR recruitment process to the sales and marketing initiatives, etc. And you can also then, you know, use tables and charts, etc., to kind of explain in summary basis and try to make this attractive. And it's often easier to tell this in a kind of a graphical and pictorial manner than it is to explain it. But either way, actually, you need to be able to explain it verbally, but you also need, you know, it's useful to be able to use, you know, graphs and charts, etc., to explain the story, and to tell the story, and how you're going to grow the business, and what are the key inputs and the key outputs from the business as you grow. So that's kind of a snapshot of the storytelling aspect of it and the financial modeling aspect of it. And just to summarize, I think I would say you need to understand how the business is going to develop and scale in a profitable manner. And that's, you know, in a profitable manner is really an important part of that. And part of that is knowing the relationship between revenue, costs, and investment. I think you need to get comfortable telling the story, as we described there a minute ago, you know, using using graphs and tables and charts, and telling that story in maybe a graphical manner is sometimes easier to digest than somebody just trying to explain it in the context of a business plan or whatever. But you also need to be able to get up in front of a group of investors and maybe spell it out in a very clear and concise manner as well. I think you also need to review the process on a regular basis. We tend to find we might start working with a startup today. In 3 months down the road, the story has changed quite considerably. They've got maybe more accurate information from the market and the potential customers. They've got feedback from investors. The environment and the climate may have changed, as it has currently with COVID. There's a whole range of factors that will change over the time that you're developing the business, and you need to be able to factor those changes into your model and into your business, so that, you know, you get the right strategy for your business at this particular point in time.
And I think sometimes founders can put a tremendous amount of energy into those perhaps slide decks or investor slides initially, and don't want to look at it again because it's a
Yeah.
source of pain and memory of what they knew back
Yes.
then, even though things move on and change. So this, but these financial KPIs really are never the specifics that you mentioned, like the pricing and the unit sales and the direct costs. Those elements you can keep on a single spreadsheet often, I imagine, in terms of your model, and you just plug
Yeah.
in and out the numbers as you get feedback from the market.
Yeah, absolutely. And I think keeping it simple is important.
Yeah.
We've seen models, we work with other models as well. Sometimes startups come in with their own models, and that's perfectly fine. And we've worked with models that, if you like, were professionally prepared. And you have 2,000 lines in a spreadsheet. And I think that just kind of gets to the stage where it's ridiculous. You need to keep it simple. You get the same information, and you possibly get better information from a model that's well constructed, but constructed in a more simple manner. We're not trying to make people accountants. The accountant's job is a different job, although many accountants will do financial forecasting as well. But this is not about your management accounts and keeping your books. It's about looking down the road and plugging in the key financial data into a model that allows you to understand how your business is going to work now and how your business might work in the future, and what your funding requirements are going to be, whether they be typically with most of the companies we work with, it'll be equity-based funding because the banks will regard them as being too risky. So it's trying to plan ahead and understand, when you're going to need your current round of funding, when you're going to need your next round of funding, and mapping that out in a coherent manner.
And I suppose when you're just starting out, you don't have enough data anyway to put in the detail of the financial elements. But as the business gains traction, gains clients, and has some kind of trends going, that's when you can get really fancy, complicated model with maybe 20 lines. It might be really helpful.
It's what I would say is actually at the very start, most founders have an idea in their head of how they think things are going to work. And it wouldn't be unusual for that idea to be unrealistic. So that I think sometimes it's useful just to throw what they know now, even if it's not validated in the context of the market or customers, etc.
Yeah.
It's useful to throw those ideas into a model, because then you will see, okay, that's not going to work. I can't recruit all those people in year one. I can't spend X amount on marketing with Google in that year either, in advance of customers coming on board. So I got to look at this in a different way. So it kind of gives a financial context to what's going on in a founder's head. It allows them to maybe, translate all of the information they have in their head and maybe on paper into a financial context, and maybe informs them in terms of what's realistic and what's not realistic at this point in time. And that's a good starting point in itself, actually.
Some comments that have come in just on the model itself. Michelle says, is the business model showing LTV, cash flow breakdown, churn, retention rate, monthly recurring revenue, annual recurring revenue, unit economics, segment comparison with other companies? I don't see any of that on that Excel sheet, John.
Some of those things we a lot. Some of the last few items they're not built into the model, but we can do it. Okay. What we often end up doing with the financial models is that we start off with a simple model, and then we can typically what happens is that each business has a different sales process and the set of assumptions that feed into the sales and direct costs, etc., are different for each business. So the one I was showing you there is kind of generic, but often we will have to customize one or two sheets to get the model as accurate as possible to reflect the business that we're dealing with. But that's essentially, you know, playing around with the setup of one or two sheets. The rest of the sheets kind of feed into that. So we can if those items are a requirement, we can address them. But often, some of the ones, I forget now, some of the points that you raised towards the end.
Yes, it was well, monthly run rate, monthly recurring revenue, annual recurring revenue, annual revenue per unit economics.
Yeah, some of those we would need to address, you know, on a case by case basis. They can be built in if they're required.
Another question then is, perhaps this is maybe more your opinion, and you have so much experience with startups and investors that I'm sure your insight would be really valuable. The question is, one question from my side is, how do you realistically evaluate the R&D cost of a software as a service product?
The R&D cost. Well, okay, so typically what happens there is that the R&D with, again, our experience, the R&D with software as a service is that a lot of that R&D is a combination of maybe two things. When we split that cost out, a lot of it is actually on the HR line. So the R&D is built up by the know-how of the team. Sometimes an element of that is outsourced. So there's an external consultancy-based R&D cost, and sometimes there might be additional R&D related costs that would come with that. If it's a product, for example, there might be prototyping or something like that. But if it's just pure tech, you know, software-based, a huge amount of the R&D comes back to the HR side of it, which is the team. And at an early stage, some of that will typically be outsourced as well, because you mightn't have the capability and you might not have the resources to employ all of the skill sets that you need. So you will outsource maybe some of the development work. And sometimes that can be done, you know, cost effectively, you know, in other countries as well. So it's a combination. The R&D work is a combination of the work that the team do and then the outsourced value.
And I suppose the return on investment eventually then, is it?
The return on investment then is what happens. Like, you know, it's not complicated in this, is can you use that R&D and that capability to generate sales and in turn generate profits? Yeah.
Very good. And then another question is, again, I think this is really probably about your opinion. I'm sure there's no hard and fast rules here, but it is a question around, what do you consider an appropriate amount for founders to pay themselves in the first 3 years of a startup?
Okay, so
contentious question or contentious?
Not really, no. I mean, I'll give you a couple of examples. It wouldn't be unusual for the founders to be paying themselves less than, say, their senior engineering people in the first 2 to 3 years. You know, I've seen numerous examples of that where there might be two founders. They start off with, you know, a lower amount of, you know, a lower salary than you would expect for their background and capability, etc. But that scales maybe over 2 to 3 years. And their software engineers and their technical people are earning significantly more than them in those early stages, because they have to bring those in. They're probably trying to recruit them. They could be competing against some of the corporates who are offering them, you know, good potential salaries for the same skill set. So it wouldn't be unusual for the founders to be paying themselves a lot less in the first couple of years. And interestingly enough, if you talk to investors and they look at a business model, one of the things they will look at is, what are the founders paying themselves in those first few years? And if they see a situation where the founders are paying themselves excessively, usually that's a red flag, because their view is your value is down the road. It's not, you're not here to drain the business of its cash flow in the early stages. You've got the equity. Your return is potentially down the road if you exit or whatever happens to the business. You've got to earn that salary. So I think excessive salaries for founders in the early years is a red flag for investors, and it's not at all unusual to see that they're paying themselves a lot less than maybe their counterparts in the business in those first couple of years.
Nevertheless, they need to earn a living, so that they're not tempted to go back on the marketplace, I suppose, and the jobs market.
Of course, and that's recognized. It's not that they're expected to be they're not paying themselves anything. It's just that it's not maybe exactly the going rate for their skills and experience in the marketplace. And it's all about, in those first 18 to 24 months, it's sometimes described as the valley of death, until the business becomes somewhat established, has traction in the marketplace. You need to preserve your cash flow, and you need to be smart and you need to be wise with it. So, I think it's a good signal to investors that you understand that, and you're spending money where it has to be spent, and you're managing your cash flow as best you can.
John, another comment that it would be great to see some examples of scenario analysis and how best to do this within a financial model spreadsheet. So you're going to share the spreadsheet with us, and we'll send out to everybody registered today. And in terms of examples of scenario analysis, then in simple terms, would that mean just as simple as saying, well, okay, well, what if we don't make our sales target next month?
Yeah.
Or what's the worst and best and most likely scenario? And you put in and out your numbers?
Yeah, I think, what you might do is start off with a blank page and say, okay, the upside, the best, the optimistic version is this. And you write down, what that might look like. The pessimistic version is this, and you write down what that looks like. And then there's something in the middle. And it wouldn't be unusual for a company to have three versions, which is the optimistic, the pessimistic, and then the middle version. And what you're doing there is you're probably flexing both the sales and the costs. And when it comes down to it, what you're doing is you might be saying, let's say we reduce sales in year one by 20%. That will have a knock-on effect in year 2, year 3, year 4, because you're in catch-up mode then. So you would expect to have slower growth and a lower level of sales in years 2, 3, and 4, or 5 if you're going out that far. In terms of the costs, what you're typically doing is, and you're really you're drilling down into the detail. In terms of the costs, you're saying, okay, we're going to slow our recruitment plan. We're going to move that recruitment plan out by 3 months for everybody or 6 months for everybody, or we're going to relook at how we do this completely. We look at our business development and our customer acquisition costs and see what we're going to do there. And if you change your customer acquisition costs and your business development costs, that is probably going to have an impact on sales anyway. So it's sitting down and I think making straightforward, logical decisions on both the sales side, on the cost side, and see what the impact of those are. And then the third thing that you can do is look at your funding. The what if we can secure 1 million, it will allow us to do X. If we can only secure 500K, it's only going to allow us to do Y. So it's mapping it out with taking account of the various variables that you have control of at this stage. And those controllables are usually, your HR team, your investment, if that is a controllable. But you will usually get a good idea of what's possible on the investment side from talking to, say, investors on the one hand, also the likes of Enterprise Ireland on the other hand, if they're an option in terms of funding, or whoever the funding options are. So you will get an understanding of, if we can only secure 500,000, then we have to cut the cloth to measure.
Sure.
And it's as simple as that.
Yeah. John, thank you very much for the last hour you've spent with us. I'll just encourage anybody with any more questions to pop them in the chat and let us know. And you've got some thank yous coming in already. Just before you go, could you tell us who typically arrives at your door and at what stage do they arrive? So are you going to welcome all entrepreneurs, even maybe very early concept stage, or do you prefer them to be a bit further down the line? Or what typically would you like to see and to understand from our, how open are you to people knocking on your door?
Well, actually, sometimes they do knock on the door. Sometimes we get referrals in through, the
not
website.
Anymore, not these days.
Well, no, no, you can't even get through the door here at the minute.
No.
So yeah, sometimes we get, startups contacting us directly. Often our referrals come through the likes of Enterprise Ireland, sometimes the local enterprise offices. We would work closely with, say, New Frontiers programs in the region, etc. So, and we'd work with the university, with the accelerators, the incubators in the region. So it's not like they're just sort of falling off the trees. Startups are usually connected with some sort of a network, whether it be a startup network, an incubator, accelerator, or whatever. So often our referrals are coming through those. And what we are always trying to do is work with the best companies possible, the high growth guys, whether we do a lot of work in medtech, we do an awful lot of work in tech in general. But we've also worked with, smart manufacturing and tourism businesses, for example, as well. So we're open to working with any kind of business. Our ideal businesses are those high growth guys. We work very closely with Enterprise Ireland, as do the other BICs, and our aim always is to get as many high potential startups over the line. And we were chatting about this earlier, Rose. What does over the line mean? So from our point of view, that means getting those enterprises fully invested in maybe a seed round or a scale-up round that allows them to basically take the business and grow it as quickly as they can. So we work closely with Enterprise Ireland in the HPSU unit in identifying the type of companies that we want to work with, and then giving them that one-to-one support in a really detailed manner. And at some stage, at various stages, we'll start off working with a company and it looks like this is going really well and we'll have this over the line in maybe 3 to 6 months, and then something happens. Could be COVID, or it may not be COVID. Could be
market
customer feedback, all of that, and suddenly that looks like a much longer prospect, and it's going to take maybe 9 months to 12 months to get that to where we'd like it to be, because there's maybe a need to go back and reconfigure the product. There might be a need to go back and develop relationships with customers in maybe a slightly different niche of the marketplace, because you realize you're barking up the wrong tree and you need to look, but there is an opportunity somewhere else. So it's we always have a pipeline. Where I'm getting to with this is we always have a pipeline. The pipeline moves at a different pace depending on what's happening with the startups, and we're always trying to move them along as quickly as we can. And we're not working in isolation. We work very closely with the DAs, the development advisors in Enterprise Ireland. If they're on the New Frontiers program, we're working with those guys. If they're in an incubator, we're working with the incubator as well. So it's kind of a joint effort to try and get these companies up and running, so that they can hopefully scale into the future.
So another question is, how does Westbic charge for their services?
Okay, so if you're a potential HPSU and you're working through Enterprise Ireland, there is no charge, because our funding, a chunk of our funding comes from the work that we do with Enterprise Ireland, and it's the same for the 4 BICs. So as I said at the outset, we're part of the enterprise ecosystem, government's enterprise ecosystem. So we're funded through the Department of Enterprise, and our that our funding comes to Enterprise Ireland. So there's a very close relationship there with Enterprise Ireland.
Fantastic. Okay, so usually people setting up in Ireland start with local enterprise office, or they
Yes.
start with a New Frontiers application, but they can start by going directly to you and maybe would they send you an email, John, or check out your
Yeah,
website?
sure.
Yeah.
Yeah, either or.
So if they're based kind of west of the Shannon, they go to Westbic. Is that it?
Broadly speaking, yes.
Yeah.
And if they're Dublin or Leinster, you're talking about Dublin Bic, and then Cork Bic would service Cork would service Cork, Kerry, and parts of Limerick.
Okay.
And then CBIC is Waterford, Wexford, and the southeast in general.
Okay. So a fantastic service, really amazing service that is available to entrepreneurs free of charge.
Yeah, absolutely. And look, it's the amount of time we spend with each startup in terms of trying to progress them through that investor ready process. It's not a service that the startups could pay for because of the amount of time. If you were going to a finance house to get that service, it would cost you an arm and a leg. It's just not possible. So that's where the state support process is really important and adds a lot of value to the startup ecosystem in Ireland, and like the BICs are actually, the BIC started off in Europe originally. So they were a European initiative through the EU, and there's well over 120 of them across the EU, and we're networked as EU BICs.
Great.
So we kind of share that network as well, and we can also bring that to bear with the startups. And I think the BICs are an important contributor to that startup ecosystem, and it's because I think we can give the time to drill down into the detail and work in a detailed one-to-one manner with those guys that are coming through the pipeline.
And using your experience, which is the best part of it, really, isn't it? So it's like seen so many.
And we're dealing with across the whole range of sectors. It's great. I get really enthusiastic about the quality of the startups that we're working with these days. Some of the stuff that comes through the door, from the tech to the med tech, it's really encouraging from an Ireland Inc. perspective that we have this potential that's developing all the time in the country, and the quality of the entrepreneurs is first class, I believe.
That's great to hear. And we're seeing in Accountant Online, we're seeing really that entrepreneurship has not declined. If anything, a lot of people who are in difficult circumstances at the moment are using this time for really as a creative time to say, well, okay, maybe it's time for me to set up on my own. So it's great to know those supports are there. They're so important, because it is a risk people take to set up.
Oh, for sure.
Really important, one last question is, where would you go if you were in Cavan? Would you go to Dublin BIC or would you go to Westbic, do you think?
We'd happy to entertain a query.
Great. Okay, you
Cavan.
get one more for your pipeline then, John. Okay, we'll send them over to you. So thank you to everybody for joining us today. Thank you so much, John. It's been really interesting. And we'll send out your template and your slides to everybody registered for today's webinar. Do let us know also via the hello@accountantonline.ie email what topics you'd like to see in the future. This business growth webinar series has been really popular in the last few months, and we want to keep introducing you to insightful aspects of the entrepreneurship ecosystem around Ireland and all the supports that are available to us in business. And just let us know how we can help. Okay, goodbye everybody. Thank you.
Thanks, Rose.